Welcome again to the financial accounting lecture. Today we want to continue with the questions that we started with last time. 18 says the total of the list of balances in various payables ledger was 438 at 30th June 2006. This balance did not agree with the various payable ledger control account balance. The following errors were discovered. We've got a contra of 980. We've got the total of the purchasers returns daybook undercast. We've got an invoice which was posted to the supplier's account as 4434. What amount should value report in the statement of financial position? Okay, so we're dealing with personal accounts here, and that means that we are not going to be affected by the second error, because the second error deals with daybooks, and daybooks normally feed directly, the totals of the daybook feed directly into the general ledger. A contra of 980 was recorded in the payable ledger control account but not in the payables ledger. Will affect us, and also I think the third transaction. So let's write something. 438 900. I hope that this is where we had ended. So closing balance. That is a draft. 438 900, and then we say a contra which was not recorded, 980 less contra. Okay, and then we say the transposition error, an invoice 4344 is recorded as 4434. So there's an overstatement there. We call that an overcast because let me just get back 4434. Yes, I think that could have seen this. Yes, so when you do the maths, when you okay, let me just do this. You get all of them. When you sum up everything, that's the figure that you're supposed to have, which is 437 830. 437 830. All right, so that's what we have there, and of course the answer is D there. I want us to progress to the next question. According to IS2 inventories, which two of the following costs would be included in valuing the inventories of a manufacturing company? Carriage inwards we take, carriage outwards no. That is a distribution cost, depreciation of factory plant. Yes, we can take an overhead, general administrative we don't. So it is only 1 and 3. So B is the answer there. Let us progress to the next one. It says Prisha has not kept accurate accounting records during the year. She has opened inventory. She has the inventory, opening inventory 67, purchases 84 during the year. At the end of the year, she had 54 left in inventory, and all sales made at the markup on cost of 20%. What is Precious gross profit? So this is a good example of it's a good example of an incomplete record question, and of course very soon we'll deal with other things. So let me go to that. If I can format this record, this Excel, so that we have a clear view, I think that would help us. I think that would help us. So what we have here, we need to establish the cost of sales, of course, and we all know cost of sales. This is the revision class is equal to opening inventory plus purchases less closing inventory. Okay, closing inventory. There we go. If I may counter check my figures, we are told 84,000. Okay, 67 is the opening, 84,000 is the purchases, and what is the closing? The closing is 54. So that is our cost of sales there. Now the question says, what is Precious gross profit for the year? All sales are made at a markup on cost of 20%. So markup means profit is deduced on cost. So gross profit will be equal in this case to the same 85. Then we multiply that by 20%. Okay, I think that should not be very difficult. So we get the figure supposed to be, this is actually supposed to be 300. 85.3 multiplied by 20%. Let me put some equal sign there. I'm getting that figure there, 70,060, and I hope that that's what you're getting as well. So there's a B there. Alright, let us progress to the next question. The next question deals with capital structure, and it says, what was the company's, I'm going straight of course to the requirement, what was the company's capital structure at 31st December 20x5? Capital structure, and you have been given the number of shares. Ordinary shares capital was 500,000, valued at par 25 cents, and share premium is 100. In the year ended 31st December, company made a rights issue of 1 share for every 2 held at $1 per share, and this was taken up in full. Notice that there was a premium here because $1 is more than 25 cents by 75 cents. $1 is more than 25 cents by 75 cents. Later in the year, the company made a bonus issue of 1 share for every 5 held using the share premium account for the purpose. What was the company's capital structure? Again, the question is rate. So we are running with 125 and 100. So if I may, this is question 21. This is capital structure, of course. Change in the capital structure. Run with share capital, which I'll call SC, and we are also running with share premium, which I'll call SP. And of course, the values are given for us. The opening balances, OB. Here we had a 125, and here we had a 100,000. I hope that you can see that. Just make that one a little bit simple. Okay, now there was a rights issue during the year. So let's get on to the question. See what is basis. Our company made a rights issue of 1 share for every 2, meaning is what happened. They said 5. Remember, we are running with 500 shares. Multiply 1 divided by, what did the question say? Every 2 held. Every 2 held. Then you multiply that further by the par value, please. The par value in this case is 0.25. That is for the share capital. Okay, so let's do the work. Say 500 shares multiplied by 0.5. 1 over 2 is 0.5, please. Then point that. I'm getting that figure. And then for the share premium, you do a similar thing. You say, excuse me, 500. Okay, say 500 shares multiplied by 1 divided by 2, or 0.5. But this time around, you say, what is $1 minus 0.25 or minus 25 cents? That gives us 75 cents. So we can say multiplied by 0.75. We are getting that figure. Okay, so the whole idea is to ensure that these figures are added. Let me just add them. Let me just sum up. I add these. Okay, so now we are standing after the rights issue. We are standing at those totals. We have not yet reached our answer, because now there's going to be a bonus. And remember, initially we had 500 shares. We have issued half of 500, which is 250. So now we are running with about 750 shares. That's just the way it is. Now we are told that there was a bonus, issue 1 for every 5, which shall be financed by the share premium. So again, the bonus will look as follows: 750 shares now multiplied by 1 divided by 5 multiplied by the par value, which is $0.25. Again, I go there. I say this is equal to 7. If I can just open brackets for the sake of clarity, 750,000 shares multiplied divided by 5. It's as simple as that. Then we multiply whatever we find by 0.25. I'm getting that figure. So we're increasing share capital by 37.5 and reducing share premium with the same amount, 37.5. Okay, so when you do the work, when you do the maths, you will discover that, let me just work that one out nicely. Okay, so I get that. Okay, I add share capital and then share premium. There will be a lessing, of course. Okay, so when I check, this should be the new position and this should be the answer after the bonus issue. So let's go check our, we go and check our, so what do we have? Ordinary share capital 225. Let me just check that. There we go. Then share premium 250. There we go. So let's check, says 225B and 250 there. So let us remember how to do these works. I want us to go to the next question because of time. Of course, we have spent a good number of time there for a reason, of course, and I hope that you can come up with question. Question 22 says, which of the following should appear in a company's statement of changes in equity? Total comprehensive income for the year, yes, that should appear. Amortization of capitalized development costs, no, that goes to the profit or loss. Surplus on revaluation of non-current assets, yes, that can appear. So 1 and 3 only, 1 and 3 falls under C. I didn't have to take too much time there. Okay, next question, question 23. It says the plant and machinery account at cost of a business for the year ended was given as follows. We have got the opening balance brought forward 240, addition 160 on 30th June. On the other side, we have got 31st March transfer for disposal account or to disposal account of 60, and the 31st December, we have got a closing balance of 340. The company's policy is to calculate depreciation at 20% per annum with proportionate depreciation in the years of purchase and disposal. What should be, that's the question now, the charge for the year 31st December X5? So it's a nice question, and of course we're supposed to be dealing with question 23 if I'm not mistaken. Depreciation. Depreciation. I want to just state that these should be an easy bit. So let's look at our account again and get the total figure for the sake of clarity, and let me just do that. The total figure for our account is 400. Okay, so you go there, you put a 400, and then now you begin to play around with the numbers. Really, you can less the additions, what you bought during the year, which is we bought one assets with 160 during the year. What else do we have? Again, less transfers or disposal, the value of disposed assets. We disposed assets with 60,000. Okay, so that now you say existing remaining assets, okay, or held for the full year. So assets held for the full year, it will be the difference between the 400 and the two figures that you have. So assets held for the full year is that. Okay. Let us now begin. Forget about the 400 for now. Okay, let's run with the other figures. I'd like to start with the assets held for the full year. So for the assets held for the full year, depreciation should not be very difficult here. Yes, for the assets held for the full year, depreciation should not be very difficult. So let me just calculate depreciation quickly for us. Because I'm not using the whiteboard, I'll just be doing these works here so that you can see what is going on. Okay, so I'll do, say, 180, okay, for this depreciation by, supposed to be 180,000 by 20% multiplied by, of course, 12 divided by 12, meaning that I held these assets for the full year. So this is as good as saying 180 multiplied by 20%. I'm getting that. Then for the disposal, I have to be careful with the date. My cut-off is 31st December. I disposed of these assets on 31st March. So really, I held the assets for 3 months during the year. So I hope that you can see that. So I will again write something for you so that you can appreciate what is going on. 20% by 3 divided by 12. Yes, so again, in my Excel, what is happening? 20,000 multiplied by 20% multiplied by 0.25 is as good as 3 over 12 is 0.25. Please use your calculator to confirm that. Okay, then finally we have got a 160. When did we buy these assets? We bought these assets halfway through the year, so 6 months held. You can always check that. 160 multiplied by 20%. I'm just working out something for us to make comparison. Multiplied by 6 over 12. So when you come here, you say the same. You say 160,000 multiplied by 20%, which is as good as that. Multiply further by 0.5, which is as good as that. And by the way, this is supposed to be a percentage. That's supposed to be a percentage. Let me just sum up and see how far I go. So I'm getting a 55. I hope you're getting the same figure there. A 55 down here. Okay, D is the answer. Let's progress to the next one. The following extracts are from Hassan's financial statements coming out of ratio analysis, profit before interest and tax, interest actually, and then tax. We've got profit after tax, share capital reserves, loan liability. What is Hassan's return on capital employed? Rules. It's a nice question, but of course simple. All you need to do is to remember certain things. Question 24, rules, okay, is equal to profit before interest and tax, divided by capital employed. So in our question, the profit before interest and tax, of course, is 10.2. I can see that divided by the capital employed, which is share capital or equity. Equity means share capital plus reserves plus any long-term liability, which is 42.5. 42.5. So when you do the maths, you will discover that you're running with the following. Multiply this, of course, by 100%. If I may use a percentage, all right, you can see that, yes, That is the figure that we have. The return on capital is 24%. So it's a C there. Okay. Let us go to the next question. 25 says what? Which of the following statements about tax is or are true? Sales tax is an expense to the ultimate consumer of the goods purchased. That's correct. Then 2 says sales tax is recorded as income in the accounts of the entity selling the goods. No, it's not. That belongs to the government. So 1 only, and the answer, of course, is A. No need to waste time on that. All right, almost there, and you can always ask questions on the other side. I'm now going to question 26. Question 26 says, Q's trial balance coming out of correction of errors, I suppose, failed to agree, and a suspense account was opened for the difference. Q does not keep receivable and payable control accounts. Following errors were found in Q's accounting records. Question is, which one of the errors will require an entry to the suspense account to correct them? So I begin. 1 says, in recording an issue of shares at par, cash received 333,000 was credited to the ordinary shares capital account at 330. Of course, that's different debit, different credit, so the suspense account will have to be opened. Okay, so the suspense account will have to be opened. Then 2 says cash of 2.8 paid for plant repairs was correctly accounted for in the cash book, meaning credited, but was again credited to the plant asset account, meaning we have got double credit. Again, that will require a suspense account correction. Then 3 says the petty cash book balance of 500 had been omitted from the trial balance. Again, that will mean that the debit side of the trial balance is low by 500. Again, that will require a suspense account. And then finally, a check of 78,400 made for the purchase of a motor car was debited to the motor vehicles account as 87,400 transposition error. That will again require what we call a suspense account. So the answer is supposed to be all the options. The answer is supposed to be B. Okay, let's go to question 27. Prior to the financial year of 31st July X9, Canon Company has received a claim of 100 from a customer providing poor quality goods which have damaged the customer's plant and equipment. Canon's company lawyers have stated that there is a 20% chance that Canon will successfully defend the claim. Which of the following is the correct accounting treatment for the claim in the financial statements for the year ending 31st July 20X9? So in such kind of cases, we need to look for the probability that we are going to successfully defend the claim. In this case, we are told that we have got a 20% chance, and it means the customer has got an 80% chance of succeeding against us. So it is this particular case has got a very high potential outflow, and therefore we're supposed to recognize what we call a provision. A provision is simply a liability of uncertain timing and amount, of course, resulting from what happened in the past. So this provision should be recognized. Provision should be recognized. And how much are we going to recognize? Normally, lawyers give us what we call a stated amount, but in this case, we do not have. So we go for the option that, of course, will be prudent. So A says Canon should neither provide for nor disclose. I think this is material. I think that would not be correct. That would result in overstated profits. B says Canon should disclose a contingent liability. But again, contingent liabilities have to deal with possible obligation. This one is no longer a possible obligation. This one is virtually certain. Then C says Canon should provide for the expected cost of the claim of 100. I go for that. You provide in full. You can't restrict yourself. In D says restrict yourself to 20% of that amount. You don't do that. So prudence concept says if we have anticipated losses, those losses must be provided for in full. Okay, 28. Gareth. So the answer there, of course, is C. The answer for 27 is C. 28. Gareth, sales tax registered trader, purchased a computer for use in his business. The invoice for the computer showed the following costs related to the purchase. So we have got computer 890, we have got additional memory, we have got delivery, we have got installation, we have got maintenance. Question is, how much should Gareth capitalize as a non-current asset in relation to the purchase? So we're gonna assume certain things here, that he can get a refund for his sales tax. We can also notice that maintenance costs are normally treated as revenue items. So the capitalized figure should be 1040 minus 1040 minus this is supposed to be question 28 if I'm not mistaken. 1040 minus 28 capitalize. Okay, I am writing something for us. Excuse me. 1040 or 1000 minus 25. How much do we have? If we can do the maths. All right, say 1040. Don't take it for granted that the students know these things. 1015. So that's the answer there, ignoring of course the sales tax, assuming of course that the sales tax can be recovered. So the answer is supposed to be D. Okay, let me now go to next questions. Set of questions. Oh, we almost there. 29 says, following bank reconciliation statement was prepared by a trainee accountant. We have got an overdraft, we have got less than presented checks, we've got add outstanding lodgements, and then we've got that figure. What should be the correct balance as per the cash book? I think what the trainee accountant didn't just do right was the opening balance. Every time the word overdrawn is used, we need to use minus. We need to put the figures that we have in parentheses. I hope that you will be able to remember that. So let me just show you something. This was question 29. Question 29. So overdrawn, brought forward overdrawn, or brought forward overdraft. That's what we call it, overdraft. You can always put a minus, please, whatever figure you have. Then you say less unpresented checks, then add outstanding lodgements, and then you have your closing balance. We call it revised cash book balance. Okay, so let's try to do some work. Overdrawn amount, if I may, let me just increase 3860. That should come in as a minus 3860. And then next, everything else was done correctly. 9160, you less 9160, and then you add 16690. 16,690. Is that correct? Let me check again. 16,690, that's correct. So if we sum up, we should be getting a 3670 rather credit, and if we check, supposed to be 3670 balance at the bank, not overdrawn, because that figure is not negative. So the answer is supposed to be B. Okay, nice. 30th question. The RSB conceptual framework for financial reporting identifies characteristics which make financial information faithfully represent what it purports to represent. Which of the following are examples of those characteristics? So ingredients of faithful representation: accruals is definitely out of question. Completeness we get. Going concern out of question. Neutrality we get. So 2 and 4 are your options here. So we go for B. That was a theory question. And notice that on theory question we don't spend a lot of time. Okay, so thank you very much for listening in. I think I would like to end here for the sake of clarity. I'll do the last 5 questions and then we can see if we can do some essay questions later on. Thank you very much for listening, and I hope that you're going to utilize these questions and the explanations